Why is everyone constantly looking at these charts? What do these bars mean? Why is one thick and the other thin? Why is one long and the other short? Who decides when one bar should turn into another? I've broken down all these elements to the basics. Trading for beginners is easy. In this video, I'll explain every small detail and how to use it to make money in trading. Let's start with these colorful bars called Japanese candlesticks. What are they? A Japanese candlestick is primarily information about how the price of an asset behaved over a certain period. For example, if we open a daily chart, one candle will represent the price movement for an entire day. Usually, these candlesticks are shown in two colors, green and red. But what's the difference between them? If the price of the asset at the end of the day is higher than it was at the beginning, we get a green candle, which means that asset's price increased. This shows that buyers were stronger than sellers. Similarly, a red candle forms if the price at the end of the day is lower than it was at the start. This means sellers were stronger than buyers. Now we can look at charts not just for one day, but also for 50 minutes or any other period. The principle remains the same. It's like zooming in and out in Google Maps. You are viewing the same area but from different distances. But why do most traders use Japanese candles? It's simple. They are the best tool for understanding price movements. A candle consists of two parts, the wick or shadow and the body. The tip of the upper wick shows the highest price, while the tip of the lower wick shows the lowest price during the chosen period. The body of the candle works a bit differently. For a green candle, the bottom of the body is the opening price. The top of the body is the closing price. For a red candle, the top of the body is the opening price. The bottom is the closing price. Isn't this enough to understand a chart? No. Before diving deeper, we need to grasp what influences price movement and understand two basic concepts. Without this foundation, there is no point in looking at these charts. So, why does the price go up and down? Let's say I want to sell my Bitcoin for $60,000. I place the sell order on the exchange. Bybit is the best platform for this task. If you sign up using my link, you will receive up to $30,000 in trading bonuses. All links are in the description. This visually looks like a list of all sell orders. Other traders see many people selling at $60,000 and they start setting their price slightly higher, say $60,100. This cycle continues as long as they are buyers willing to purchase at those higher prices. It's a simple demonstration of supply and demand. Sellers raise prices as long as they are buyers willing to pay them. The reverse process works the same way. And this is a simplified explanation to help you understand. I explain these simple breakdowns of basic tools and the best ways to earn in crypto in my free Telegram channel. The link in the description. Now back to charts and candles. Concept 1. Large candle body. The body of a specific candle tells us the strength or weakness of buyers and sellers. For example, here we have two green candles. The first candle has a large body with relatively small wicks. The price opened here and also sellers tried to lower it initially, they were weak. Buyers quickly stepped in, pushing the price higher. Then buyers were able to push the price significantly higher without much pressure from sellers, resulting in the price closing very close to its maximum. This shows that buyers were much stronger than sellers during this candle. In the second candle, the story is quite different. The price opened here and buyers started pushing it up, reaching a new high. But at the peak, sellers stepped in and drove the price down. Sellers were powerful and almost fully pulled the price back to the opening level, but buyers barely managed to close the price above the opening. In this case, we see that buyers were stronger than sellers, but the difference in their strengths was minimal. But what if the candle's body is relatively larger than its wick? This indicates that either the buyers or sellers had control of the situation. On the other hand, when the body is smaller than the wicks, it suggests that there were less control from either side and it was a more challenging battle between buyers and sellers. Concept 2. Large wicks. Whenever we see a lone wick above or below the body, it gives us an important clue about price movement. What does it mean when we see a lone wick above the body? It indicates that sellers are strongly selling at these levels, and for the price to rise, buyers will need to put it a lot of effort. Similarly, if we notice a long wick below the body, it tells us that buyers are strongly purchasing at these lower levels. If sellers want to lower the price, they'll need to overcome these buyers. The concepts of the body and wicks are key to understanding the basic patterns of the Japanese candlesticks. Now let's move on to the main question of trading: when to buy and when to sell. To answer this, we need to understand basic patterns or movement templates. They are like green and red traffic lights for drivers. Now let's learn these patterns. Be prepared to watch each one 2-3 times to better understanding. Feel free to rewind and rewatch until everything becomes absolutely clear. Pattern 1. Bullish pin bar or bullish candle. This is a strong reversal pattern in Japanese candlestick analysis, indicating a potential upward price reversal. This candle consists of 3 elements: a small green body, a long wick below the body, and a tiny or non-existing wick above the body. How we can explain what we are seeing here? The price opened around this area, and immediately sellers tried to push the price down. They managed to lower the price, but at some point the lower price levels triggered buy orders from the buyers. The buyers were significantly stronger than the sellers. Initially, the sellers tried to crash the price, but the buyers stepped in and pushed the price above the opening level. How can this be useful in a real trading situation? If a pin bar appears after a significantly price drop, it indicates that the sellers have lost their strength and buyers are now stepping in to push the price upward. To begin trading, we need to consider other factors to confirm our view. We'll discuss this later, but if we see an opportunity to buy this kind of pin bar, we can place a buy order above the pin bar's high, set a stop loss below the pin bar, and target the next resistance level. Pattern 2. Bearish pin bar or bearish candle. A bearish pin bar is the opposite of a bullish pin bar. It's a red candle with a small body and long wick above the body, and a tiny or non-existent wick below the body. It signals a potential downward reversal. What does this mean? The price opened here, and buyers started pushing it upward. They gained some ground and created this high, but then sellers stepped in and drove the price down. As the price fell below the opening, sellers managed to keep it below the opening level, and the candle closed near its lows. At this point, sellers gained the upper hand over buyers. If we find further confirmation at this level, we can place a sell order below the pin bar's low and set a stop loss just above the pin bar. Pattern 3. The doji pattern. The doji pattern is the only candlestick formation that doesn't provide information about where the price will go, but it's important to understand. It's characterized by a candle with roughly equal wicks above and below a small body. The opening and closing prices are somewhere in the middle of the candle, and the body of the candle is very small. This shows that neither buyers nor sellers were significantly stronger during this period. Does a doji candle tell us anything? No, it only indicates a brief pause in movement, but if we see several doji candles in a row, it tells us that buyers and sellers are betting for control and there is no clear winner. In such a situation, the price typically makes a sharp move in either direction. Now let's move on to intermediate patterns that consist of two candles. Pattern 4. Bullish engulfing bar. And this pattern consists of two candles where the green candle completely engulfs the red candle before it. Simply put, we first see a red candle below it for a green one. The green candle's high is above the red candle's high, and its low is below the red candle's low. What happened of the chart? Sellers were in control during the red candle. When the new candle opened, the price dropped and broke the previous low, but the buyers suddenly stepped in. They overpowered the sellers and pushed the price above the previous high. Buyers covered a much greater distance than sellers. This indicates that buyers are now in control and ready to push the price higher. To enter a trade on the breakdown, we can place a stop loss below the low and the engulfing candle. Pattern 5. Bearish engulfing bar. A bearish engulfing pattern consists of two candles, where the red candle completely engulfs the green candle before it. The low of the red candle is lower than the low of the green candle. It's similarly the high of the red candle is higher than the high of the previous candle. What does this mean? Initially, buyers were in control, pushing the price upward. Then, when the new candle opened, buyers tried to continue driving the price higher and even managed to break the higher of the previous candle. However, sellers saw this as an opportunity and started selling. The selling pressure was so strong that it pushed the price below the previous low. Sellers covered a much greater distance compared to the buyers, which means they now have control over the market. We can place a sell order below the low of the engulfing candle and set our stop loss above the high of the candle. Now let's move on to more advanced patterns. Pattern 6. Morning star. This pattern consists of three candles and signals a bullish price reversal. The first candle is a strong red candle with the relatively large body. The second is a doji candle with a small body and long wicks. The doji candle can be either green or red. Then we have a large green candle that breaks above the high of the doji. The strength of this pattern is determined by the size of the green candle. If the green candle is about the same size as the red one, it presents a good trading opportunity. If the green candle is smaller than the red one, it's a lower probability trade. Finally, if the green candle closes above the red candle's high, it's considered a strong reversal signal. Now let's look at the psychology behind this pattern. At first, the red candle shows us that sellers were in control of the market, driving the price down. Then, buyers stepped in and pushed the price up. Eventually, the sellers lost the battle and buyers took the price higher, forming this green candle. Buyers changed the market direction and an upward move is now likely. How to trade this pattern? To enter the trade, we place a buy order above the high of the green candle. We set our stop loss below the doji candle. Pattern 7. Evening star. The evening star is the complete opposite of the morning star pattern. It consists of the three candles. The first one is a green candle with a large body, followed by a small doji candle with a small body, and finally a red candle with a large body. The psychology behind this pattern shows us that initially buyers were in control, forming the large green candle. Then sellers stepped in and started challenging the buyers, which is why we see the doji candle. What does the doji candle indicate? It shows that buyers and sellers were in a tug of war with no clear winner at first. But then sellers won the battle and began to push the price down, which is confirmed by the large red candle. To enter a trade, we place a sell order below the low of the red candle and set a stop loss above the doji candle.